Welcome back to the Joseph Carlson Show. We're back again with round two. We're going to be looking at a whole list of super investors, what they've been buying, and I'll be doing analysis on their portfolios and their recent purchases and sells. Now, if you missed the first part of this video, go back and watch the most recent episode on this channel. I go over a number of different investors that are all great, but in this one, we have an entirely new slate of investors with their recent 13F filings. We have the big one, Warren Buffett with Berkshire Hathaway. We'll be talking about that. We're going to be looking at Bill Ackman. He made a large purchase into a tech company, and it's caused a lot of buzz. I'll be going into that as well. We have Kantesaria with Valley Forge Capital Management. It's an investor that I deeply respect. He's made some position changes. And then we have Daniel Loeb with Third Point. We have Icahn, the vulture capitalist. We have Christopher Bloomstran, a deep value investor, an expert on Warren Buffett and Berkshire Hathaway and insurance businesses. Then we have Chase Coleman of Tiger Global Management, a tech investor that makes very aggressive bets. And then finally, we're going to take a look at Bill Gates' portfolio and any changes he's made. He has a lot of money, $36 billion, and they have it in this portfolio. So we'll be going over that as well. So needless to say, we have a lot to get into. This is going to be a very fun video. I'll have timestamps throughout it with each investor if you want to jump to a specific part, but I think all of this will be very interesting. So without further ado, let's go ahead and jump right in. Now, first of all, we're going to be jumping in to Warren Buffett with Berkshire Hathaway. It's always interesting to look at their 13F filings and see what they've been up to. Now, we're using a website here called Dataroma. We can go over to the sell right here, and we can see what he's been selling. Let me zoom in on this so you can see it. I ordered it by the biggest change in percentage of the portfolio. So the biggest sell was 1.54% of Chevron. Then he sold the Bank of New York, so he sold some banks. Now, he also sold entirely out of his small stake of RH, which is Restoration Hardware. For some reason, this ticker, RH, I always think of Robinhood, but I think that's Hood. RH is Restoration Hardware, which is a consumer cyclical furniture company. And this type of company does not strike me as a Buffett type of company. A furniture company is a very, very difficult business, not one that I think is an easy one operationally in complexity. It has a lot of risk factors with it. So I was surprised to see him actually buy into this one. I think it would have been one of Buffett's lieutenants, but now they're out of it. And it's a small holding, so it's not a big game changer for the company. But this is going to damage a lot of the investment thesis of many people invested in Restoration Hardware. Because I've seen many people say, well, I own Restoration Hardware and Buffett owns it, and that's part of what validates their buy into the company. And this is why you should not buy a company just because someone else did. You should have your own investing thesis. But he's completely out of the Bank of New York Mellon Corp. He's completely out of Restoration Hardware, and he finally sold the rest of his remaining shares of TSM. A lot of people are also perplexed about this. Buffett's all about reducing risk. He rethought the holding of TSM. He thought that it has some geopolitical risks with China and an invasion, and that could dramatically impact the company. So he sold out of it. And this shows that Buffett can change his mind. I get criticized sometimes for changing my mind or holding a company for a short amount of time. I held Church & Dwight for 4 months, and then I decided to sell the company. Changed my mind on it. Buffett did the same thing with TSM. He bought into the company. He thought about the different risks associated with it. He sold out of the company. It happens. Being able to change your mind on a holding is a benefit to the investor. It's not a detriment. It's not something that we should criticize. Now, we can go down the list here. Out of the ones that he completely sold out of, those are 3 of them. The last one is another bank. He sold out of Bank Corp. So overall, I'm seeing that he's selling a lot of banks here. He's selling TSM, selling Restoration Hardware. He also sold a bit of General Motors. He sold some Activision Blizzard. That's not a good sign for the merger. In my opinion, I believe there's still a solid chance this will close. Let's go ahead and bring up Activision and see where this one's trading. Again, this is one where I really think the deal will close. If we go to the recent news here, there's approval by the EU. So the UK blocked the deal. They said they don't want it to go through. The European Union said that they approved the deal. The European Union is right. The UK, in my opinion, is wrong. If I was Microsoft, I would still try to push this deal through. I'd say that we in a very nice way. We respect the concerns of the UK government, and we want to do everything possible to make this deal work in a way that's beneficial to everyone. But I'd also just step forward and continue to push the deal through. Having it get approval by the EU is a hugely positive sign. And if more government bodies approve of it than disapprove, I still think there's a good chance for it. But if they start piling on and all of them start to block it, then obviously the deal is going to be, it's not going to go through. So we'll see what happens. This is a little bit more of a risky arbitrage bet, but I think this one's fine because even if the deal doesn't go through, Microsoft will be fine. Activision Blizzard gets a $3 billion payday from Microsoft. So both of them will exit the deal, I don't think, in too bad a shape. Activision gets a payout. Microsoft, they avoid a deal that's an expensive deal to begin with. They can do buybacks. Both of them are in decent shape. Now, next we have trimming of 3 companies that I'm not that familiar with: MCK, CE, and AON. These are very, very small positions. We have positions here that are less than 0.5%. In my opinion, this is like starter cash for a lieutenant in Berkshire that's just trying to getting used to trading a little bit and getting used to doing this, and they're working with a smaller amount of money. These don't strike me as Buffett deals. Buffett's the one managing huge positions. Bank of America, Apple, the larger positions. These are ones that I think someone in the company that they're giving a little bit of money to manage are making these trades. Now, the big thing I want to point out here is it looks like this is a lot of selling because there's a lot of names. And sometimes people will say that you're trading a lot if you're doing a lot of selling. But come on, add these percentages together. What does this add up to? 2%? So in a 3-month period, they sold out of 2% of the portfolio. That's some trading, but not quite as much as all these names would lead you to believe. Now let's move on to Buffett's buys. The first thing I want to acknowledge is I don't believe that Dataroma is entirely accurate here. The 13F filings, I think, got a little screwed up because we have right here, for example, let me just show you. We have Apple, and we have Bank of America, and we have Hewlett-Packard, HPQ. These are 3 of the buys that he did over the past 3 months. But I read this release from CNBC that's a correction from Berkshire saying a previous version misstated Berkshire's adjustments to its Apple, Bank of America, and HP stakes. The changes were a result of inclusion of Gen Re's equity holding in the 13F filing. So CNBC is basically saying that these changes really didn't happen. These were because of something else happening to the filing. Now that also makes sense to me because it would be hard to believe that Buffett bought more Bank of America. Why would he be buying more Bank of America right now? Even Apple. Buffett likes to buy when the company goes on sale, but Apple is racing up to all-time highs. It'd be hard to believe that he bought more. So maybe the filing is correct, but I'm going to assume that these 3 companies had no real changes here. Now, if we take those out, we are left with Occidental Petroleum as the biggest buy. He bought 0.33% of the portfolio. Capital One Financial, and then after that, there's basically no change to the portfolio. All of these buys down here are less than 0.01%. That is not meaningful enough for me to even discuss it. It has almost no impact on his portfolio. So really the only buys that I know of right now are Occidental Petroleum and Capital One Financial. Now I want to take a look at these 2 additions here. We'll bring them up on Qualtrim Insights, which this software, just FYI, it's included as part of the Patreon membership. So you can try that out for free with the link in the description below. But we've brought up Occidental Petroleum here. The company year to date has traded down, and this seems like one that I could see him adding to. Buffett loves energy. He loves utilities. He loves oil companies. Berkshire has a massive industry, an entire industry of energy companies. He has a couple huge parts of industry. One of them is energy. One of them is infrastructure with utilities and things like the railroads. Another one is insurance. These are huge businesses for Berkshire. So he's been buying up Occidental Petroleum like crazy. And Buffett clearly has signaled that he would have no problem owning the entire company. He'd love to just own the whole thing. He thinks for $52 billion, he's going to get his money back plus some. So while all these other companies are going to green energy and renewables and all of that, Buffett does not mind buying into Occidental Petroleum. This is not one that I'm going to be following him into. I like watching what he's doing, but energy doesn't excite me that much. It's too cyclical. It's a little bit too boom and bust for me. Not one that I'm going to be adding to my portfolio. Now, the other buy that Buffett did was Capital One Financial. And this one's a little bit more meaningful because unlike Occidental Petroleum, This isn't an existing position. This is a brand new one. So he just bought into this for the first time. And we have a note here from Qualtrim that explains why the company's trading. It says Capital One Financial shares are trading higher after Berkshire Hathaway disclosed a nearly 10 million share stake in the company. So that's the Buffett effect. When he buys a company, there's a lot of eyes on it. A lot of people follow him into the holding. So we have it up 3% on the day. Now, if we look at this company, let me just do a quick analysis on it. Just run through it for a minute here. We have it down year to date, unlike the rest of the market. So it's a good entry point if you're looking for a dip or that type of thing. Over the past 5 years, however, this one has not really gone anywhere. We have flatness throughout 2018 to 2019, then a huge COVID dip, then a huge recovery. It went up with all the bullishness, and then it's fizzled out since 2021. And here you have Buffett initiating a position, at least Berkshire Hathaway. Revenue steadily growing 5 to 6% per year, just like the companies Buffett likes to own. We have the free cash flow that's probably growing at a little bit faster of a speed. Over the past 10 years, it's grown at 4.21%. That's not exciting to me in terms of free cash flow. Now, on a free cash flow per share basis, it's growing at a faster rate because they're doing share buybacks. The fact that it's growing at 7% annualized on a free cash flow per share basis means that they're cutting down the shares outstanding. So if we look at this, we can expect to see, we'll look at it quarterly, we can expect to see the shares outstanding going down, which they clearly are. So we have shares outstanding going down. We have a company that's growing its free cash flow per share. It looks like it pays a dividend as well, even though the dividend is not a grower. It's pretty stagnant. But overall, it looks like a good financial play from Buffett, and the company's valuation is not that demanding. So it doesn't have a huge hurdle of valuation to overcome. Now, looking at Buffett's portfolio overall, we go from positions that are very meaningful, these positions right here, and then they become less meaningful right about here. These are the top positions, the ones above a 1% weighting. All these companies down here are interesting, but Buffett has not been buying into them heavily. He hasn't been adding to them that much. They're just smaller positions that get traded around a little bit. But then the truly larger positions, the companies he's very focused on, make it up into this top 10 holding here, with Apple being the obvious outlier. 46% of Buffett's public portfolio still in Apple. Lots of chatter about how Apple's overvalued, and we even have right now Cathie Wood on Twitter saying that Apple is now a stagnant business that is overvalued. Their call options must be working for the investment to work out. They have stagnating but high margin apps business, right? Cathie Wood bashing Apple. I quote tweeted this and showed the performance of ARK Invest right here against Apple in blue right here. And you can see the difference here. Apple is up over the past 5 years, 270%, and ARK Innovations ETF right there is up 12%, or it's actually down 12%. So you have 270% performance for Apple against minus 12% performance for ARK Innovation ETF. The reason I point this out is because Buffett is the king for a reason. Not Cathie Wood, not Tiger Global, not these other investors. When I look at the best investors in the world, the biggest things that they avoid is catastrophic risks, having their portfolio go down 80%. Some investors can do well for a short amount of time, but the trick is keeping that performance up for long periods of time. Buffett does that through buying companies with very predictable revenues, companies that have very predictable cash flows, companies that have wide moats against competition. That combination there creates a very resilient portfolio, constantly paying out dividends and cash flow and buying back shares that can be reinvested and redeployed into other opportunities. So even though he might miss from time to time, I think there's a couple misses in his portfolio. He invested a little too early in Ally Financial. Paramount has been a bad holding so far. There's some smaller misses, but Buffett makes it back with his bigger successes. Apple has been a resounding success for his portfolio. And I don't agree with Cathie Wood. I don't think that Apple's stagnant at all. I think the revenue growth is slowing down a bit, but I'm still very bullish on the future of the company. They have so many levers of monetization to pull. So Buffett's portfolio, in my opinion, still reigns supreme. I think it's S-tier. I think it's incredibly good how he invests, how he trades, how he manages his portfolio. Now, moving on from Warren Buffett, we have another investor that I really like following, which is Bill Ackman. There's a lot of people that don't like him. There's some people that do like him. I'm in the camp where I think overall Bill Ackman's a good person. I really do. I think he tries to do his best. He's not perfect. He says some silly things on Twitter sometimes. He had some CNBC appearances that did not make him look good in terms of public relations. But overall, I think that he's a good person trying to make good returns with his portfolio. And the returns of Pershing Square have been impressive over a long period of time. Since inception, they're around 16% net of fees, which is pretty good. It beats out the S&P 500 by a pretty decent margin. So let's go ahead and take a look at what Bill Ackman is up to. He runs a very concentrated portfolio. And if we first look at his sells, we order them by the percentage change to his portfolio. We have him taking a little bit out of Chipotle. So he's owned this company since 2015, 2016, 2017. He was so right on Chipotle. He had this one nailed correct. And it was really interesting to see his appearances back on 2015 CNBC of him arguing with all the people on CNBC about how next year's earnings is not that important. At the time, back in 2015, Chipotle was trading at a 33 forward PE ratio. It seemed expensive. And now the stock is up over 5x since then, because Chipotle has done so many things to make the company more efficient. They've grown their same-store sales. They've opened up more locations. They have drive-thrus. They've enabled all their technology with their apps. It's been a resounding success. The stock has gone from $300 per share to now over $2,000 per share. So he's up monstrously high on this position. Chipotle now trades at a very full valuation if you look at the forward PE ratio, and he's finally trimming the position ever so slightly, 1%. Not a big deal. He's still bullish on Chipotle. He still has a huge position in it, but that is a slight trim. He's not buying it right now. The next one that he trimmed a little bit is Hilton, so 1% out of that one, and then Lowe's. He sold a little bit of his Lowe's, which is surprising because that one is not doing as well right now. Now let's go ahead and take a look at his buys. Ackman is in Google. He finally bought a big tech company. And out of all the possibilities, Meta, Amazon, Microsoft, Apple, Tesla, he bought Google. He bought both GOOG and GOOGL. I think the reason that these super investors do that is when they work with that significant of capital, it gives them some potential benefits with liquidity, but he split it up between the two tickers. So we have 8.21% with GOOG, 2.22% with the GOOGL. So a little over 10%. 10% of his portfolio is now in Google. And again, keep in mind that these are a reflection of what they've been doing over the past 3 months. This is Q1. Google has been on a roll year to date. It's up 33%. So if he was buying this company anywhere around here, which is what my assumption would be, he's already in the green. If he's held it, he's heavily in the green already. So this buy from him has already paid off significantly. So why would Ackman buy Google right now? Well, I've gone over this company many times. We're no stranger to it on this channel. Google is one of these companies that it's been undervalued, a large undervalued company staring at you in plain sight. Everyone can see Google. Everyone can see the merits of the company. They can see the valuation. They can see the cash flows of it. But sometimes good companies just don't trade where they deserve to be. That's the simple truth. And it could be because of all different reasons. I've gone over videos of why very large companies, very big ones with lots of analyst coverage, sometimes do not trade with their intrinsic value. A lot of times it's because of restrictions on institutions. They can only have a certain percentage of their allocation into Google. So Google has an artificial limit of how much money can be invested in it because of different institutions and their caps and position size. Another factor, I believe, leads to a lot of big tech companies not getting the valuation they deserve is that a lot of money managers that manage billions and billions of dollars, like Bill Ackman, they need to keep up the perception that they are special, that they have these very special insights on the market. And if they just own big tech like everyone else, if they just own Google and Apple and Microsoft and Meta, and that's the basket of companies they think is the best, how do they justify their expense fees, their expense ratios? They're 2 and 20, 2% of their assets under management, 20% of the gains. Can they really justify charging their clients that much money in fees if they're just buying Google and big tech? It's really difficult to. So there's a couple things that keep a lot of investors outside of these companies like big tech that aren't related to the fundamentals of the company. But when we actually look at Google, the company fundamentally is about as good as it gets. The valuation is very reasonable. It's trading at a 17.8 forward PE ratio, a 4% free cash flow yield. We look at the metrics of it, and it's grown every single year. Its free cash flows are growing over time. The free cash flow per share has grown 21% over the past 5 years. It went down a little bit year over year, but Google is going to recover it. We have the problem with their stock-based comp, but Google's already getting that under control. They're doing layoffs and cost cutting and cost structure control. They do buybacks. They have a huge cash balance. This company's in very good shape. It does have some cyclicality, a little bit of it, because it's in the advertising market. But I think that Google is an incredibly, incredibly good company. In my opinion, it is superior to Meta, its counterpart. I'd rather own this company, and I do own it, when I don't own Meta. And one thing I really like to see with this portfolio change of Bill Ackman is an acknowledgement of a little bit of humility. The first sign that he showed some humility was selling out of Netflix once his thesis changed. He didn't double down on it and triple down. He sold out because he realized that he didn't know what he'd gotten into. He had a thesis change and he sold out. That takes humility to admit that you had the thesis wrong. The next thing that I think shows a little humility is buying into a big tech company and not trying to outsmart the market and buy some other specific smaller value company. Bill Ackman thinks that the best value right now is Google, so he bought it. Even though that may not look individual and super unique, and he doesn't look special because of that, he bought the company that he thinks is the best. So if we look at the portfolio overall, this is what it looks like. We have Lowe's, which he reduced a little bit, Chipotle, which he also reduced a little bit, but these are still massive holdings. He's not bearish on these companies. We have quick service restaurant, QSR, Restaurant Brands International, which owns brands like Burger King. In my opinion, I've looked at the fast food industry, I've looked at all these restaurants, and I can't get behind this one. I just do not like Burger King. I don't like the service. I've had so many bad experiences there that I stopped going. I think there's much better branded restaurants, quick service restaurants. I'd rather see Starbucks in here. I'd rather see Texas Roadhouse. I'd rather see Wendy's even, I think is a better option. So I'm not sure what he sees in Restaurant Brands International. He sees a big turnaround with Burger King, but I doubt that Bill Ackman even eats Burger King. I doubt that he likes it. I can't imagine he likes the company. He's eating at Chipotle. He is not eating at Burger King. So again, I'd rather see him own a variety of different quick service restaurants. Even McDonald's, I think, is superior to Burger King in both operations, consistency of food, a lot of things. So this is what I think is the weakest holding. I'd like to see him take whatever gains he has and swap that out for something different. Hilton. This is a great one. A lot of people don't realize that companies like Hilton and Marriott do not own real estate. They're operators and they own the brand IP, similar to Airbnb. So this is a good company that he owns. Then we have the Howard Hughes Corp. That's a real estate company. Then we have Canadian Pacific. This is a holding that both Bill Ackman and I agree on. We both have it in our portfolios. It's a huge monopolistic company that just had a great merger. And then we have the new additions, which is Google. Now, because it's under 2 tickers, it splits this up, but it's really a 10% holding. Another thing I'll mention with Bill Ackman's portfolio is that some of them are international holdings that Dataroma does not track, like Universal Music Group. So he does have a position in Universal Music Group that is not reflected here. Overall, I really like Bill Ackman's portfolio. It's free cash flow generative, trading at reasonable valuations, highly predictable earnings with each one of these companies, predictable business models long term, and I think it's very concentrated, so it has a potential of outperforming. So overall, I really like it, and I love the new addition of Google to the portfolio. So far we have Chris Hone that sold out of Google. I didn't really love that move, even though he bought GE and GE has performed better than Google. So technically he's winning, he was right. But I like the trade into Google more. And I still, even with the recent 30% run, I still believe that Google's undervalued. I think the company still has more to run. Now, next up, we have someone that this is the first time I'm reviewing their 13F. It is Dev Kantesaria of Valley Forge Capital Management. He is not that well known, and I plan on highlighting him and observing some of his investing philosophy in future episodes. But Dev's an interesting person. When you listen to him, you realize that you're listening to someone he's incredibly intelligent. He's just a very smart person. He has, I'm surprised his brains can fit in his head because it seems like he has a 200 IQ. Now, he used to be a surgeon, similar, or at least a doctor, a medical doctor, similar to Michael Burry, and he changed fields. He went into money management. He has a history of going into all sorts of different things, venture capital, private equity, moving around boards and executive teams. And then he found his way to the public equity markets, which he believes is the supreme way of generating wealth in this world. The public equity markets, which is the stock market. He started Valley Forge Capital with $300,000. He's ran it for 15 years, and he's had annualized returns that are around 19% per year over that timeline, widely outperforming both the S&P 500 and the QQQ. And he's done it with almost no selling. In fact, one of the insane things about his portfolio is you look at the activity of it, and I just want to scroll through it because it's bizarre. Look at it since 2019. We have buying, and again, this includes the selling as well. So I'm not screening out the selling. We have buying all through 2021. And then we have one sell there, the first sell in 3 years. Then we have more buying, and then we have him reducing stakes and selling. Guess what? The only time he sells is in 2021 during peak hysteria where valuations are insane. That's when he finally decides to trim a few of his positions. But then it's more buying, and very, very rarely ever selling. So it's someone that he really is a buy and hold investor. He has an incredibly concentrated portfolio, and it's very exciting to look at. So let's go ahead and jump in, and we'll start off like we have with the other ones, with what he sold last quarter. He sold out of Amazon. So this was a company where Dev had highlighted that a couple years ago, he bought into Amazon because he thought that even though the company was free cash flow negative, that it was very close to an influx, a massive surge of positive free cash flow. And what's happened is Amazon has become more free cash flow negative. It's gone the other direction. So his thesis must have changed on this holding, and he sold out the remaining 3.7%. A rare sell and a rare thesis change for Dev Kantesaria. But he does look for very predictable companies. The other companies that he sold are MasterCard, Visa, and FICO. Now, he did not sell anywhere close to his total position. He sold 0.9%, 0.8%, 0.5%. These are very, very small reductions. A 4% reduction, a 9% reduction, and a 2% reduction. So he just trimmed these ones a little bit, and he sold entirely out of Amazon. If we go over to his buys, this is what he bought last quarter. And this is exciting for me because this is a company that I've been looking at extensively over the past couple of months. And I decided to follow him into this company, to buy this one. There's a number of other investors that have been buying Intuit recently. Intuit's a company that he had historically held. He already has a position in it. He increased that position by 4%. And it's a company I recently just decided to include in my passive income portfolio. Intuit's a company that I've followed for a long period of time, and I want to just quickly go over this company and some thoughts on it. First of all, we look at the trading of the company. Over the past 10 years, this has been a significant compounder. The company has compounded its returns at almost 18% over the past 5 years. 18% returns. But if we look at the past 5 years, it traded up into that hysteria range in 2021. And then like a lot of these companies, it's traded down dramatically since then. And so overall, it's been flat since around 2020. And a lot of times that gives time. When a company trades down like this, and it's a high quality company, it gives time for the actual fundamentals to catch up with the price. And I think we're at that point where the fundamentals have finally converged and they've caught up with the price, similar to what I see in Visa and MasterCard. But Intuit's a company that is a way of looking at it, a way it's described frequently is it's like the operating system for little family home businesses. You have tax preparation software. You have accounting software that's used by 80% of small businesses. You have lots of other various things that they sell. They have Credit Karma. They have Mint. That's something that a lot of people use. They have a lot of different ways of monetizing and growing these platforms. And they're growing their software upwards. So they're moving from small businesses to a little bit larger small businesses. And they're going to try to take that market as well. Intuit is a company that is heavily entrenched. It has assets like TurboTax. No matter how many times the government tries to make tax software or competitors like Microsoft try to get into this category, Intuit fights off the competition. There is a long graveyard of dead competitors to Intuit's TurboTax. I don't think the government's tax software is going to be that successful, in my opinion. We look at the revenue growth of the company. Most of this is natural throughout its history, but it has had a couple acquisitions. One of them has helped out the revenue last year. So some of this is inorganic, but the company does have a lot of organic revenue growth through pricing power. We look at the EBITDA of the company. It follows right along with the revenue growth. In fact, it's growing a little bit faster. We look at the free cash flow of the company. We can look at it in total right here. Very good free cash flow growth profile, growing at 21%. One of the problems with this company, and this is something that Terry Smith highlighted, is it's growing its stock-based compensation at an incredibly high rate. And this scares off a lot of investors. We have this clearly highlighted here in Qualtrim. The orange line is the free cash flows. That is your income from operation, your cash flow from operations minus your CapEx expenditure. But then we have the pesky stock-based compensation in purple. And this shows you that even though the free cash flow has grown over the past 5 years, we have this sudden bump up in stock-based comp in the past 2 years. This is a problem for investors. When I read into this more, a lot of the stock-based compensation is from 2 very recent acquisitions. And it's something where the management team believes that they will get this under control. They're going to actually reduce the amount of stock-based compensation, and they believe that they can grow revenue. They will grow the revenue of the company at a higher rate than all of the expenses with stock-based compensation included, meaning that the margins should go up on a continual basis from here on out. Even when you net out the stock-based compensation using the adjusted free cash flow, which is what I do here, it still has a great growth profile, growing 17% year over year. The free cash flow per share has grown at a staggering 19%, 19.67% over the past 5 years. We adjust out the stock-based compensation, and that is 15.6%. Intuit is growing their intrinsic value at a rapid pace. That is something that is undeniable. So overall, I view Intuit as a highly entrenched company that offers software that has significant pricing power, and it's diversified in risk factors away from all the other companies in my portfolio. So with all of those factors, I decided to add this one to my portfolio. Now, if we go back to Kantesaria, which by the way, I would never add any company from any investor simply because they bought the company. I think that is a recipe for disaster. So if you're watching one of my videos and I'm buying a company, don't buy it just because I did. Don't buy a company just because Buffett did. Don't buy one just because Ackman did or Dev or anyone else. If your whole thesis relies on someone else buying something, it's going to be very tough if they end up selling it. You're going to be left feeling a little bit alone, not knowing what to do. So you have to develop your own strong investing thesis if you want to make individual investments. Now, if we look at Dev Kantesaari's portfolio, I love it. I think it's just a great portfolio of compounders. The only thing that I would have in form of criticism is he takes concentration to a whole new level. He has crazy amounts of concentration. For example, his largest holding here, which is FICO, is 25% of his portfolio. Now, FICO's done phenomenal, so his level of concentration paid off. He's had huge gains in this company. He underwrote the growth of the company successfully. So you can't really blame him here. He concentrated heavily into a holding that did really well, but it still is very concentrated. It's a little bit unnerving how much money he'll put into one position. Then we have MasterCard, which is a staggering 20%. I have MasterCard as a 10% position, and I feel like that's heavily concentrated. But then not only that, he has Visa. Visa as a 7.7% position. So when you actually look at it, MasterCard and Visa share similar risk factors. So in terms of risk factors, he has 30% of his portfolio roughly into the same type of company, MasterCard and Visa. And then he's done the very same thing with S&P Global and Moody's. And one of them is a staggering 18% position. 18% in the S&P Global, and then Moody's he has 14%. Combined, that's around 30%. 30% plus of his portfolio are in these two companies. I like concentrated positions. I like going into around 10% per position. But when you actually combine the risk factors, which is both of these companies have very similar risk factors, and these ones have very similar risk factors, the level of concentrated risk factors, I think, is incredibly high in Dev Kantesaari's portfolio. So even though these are phenomenally good companies, I think that It's very concentrated, and you really have to know what you're doing in underwriting these companies if you make this level of concentrated bets. So when we look at his portfolio, in my opinion, it has a lot of similarities to Chris Hone. I think the two of them have very similar looks at investing and investing strategy. All these companies are very monopolistic by nature. They're not product makers. They're not logistics companies. They're not selling things and furniture, and they're not selling refrigerators. They're not selling cars. They offer services in a way that's very difficult to disrupt and where they have immense pricing power. That is the commonality with each one of these companies. They also have huge moats. Like, a lot of these companies have massive network effects where the more that people use them, like Visa, MasterCard, S&P Global, and Moody's, the more that people use them. That is a basic network effect. That's something that Intuit has as well. So they share a lot of similarities, and I don't think that's by accident. I believe he's filtering out a lot of different types of companies. Now, moving on, we have Daniel Loeb with Third Point. He's a bit of an activist investor, so he will go into companies and write letters trying to enact change. But over time, Third Point has become a bit more of a mature, conservative investment fund. Let's go ahead and take a look, starting off again with his sells. We can see what he's exiting out of. He sold 100% of Sentinel-1, TJX, Aventiv. We have 100% sell of Fidelity. He sold completely out of Disney. Again, he's been in and out of that company, I think 3 different times. We have a Laboratory that he sold out of. We have Jaws Mustang Corporation. We have Vintex, a bioscience company. Dragonair Growth Opportunities Corp. That seems like a real estate company, but I'm not sure. We have Disruptive Acquisition Corp. No clue what that one is. And then we have a 1 to 3 year treasury that he raised a little bit of cash from. He sold 0.08% of his portfolio in that one. The top buy last quarter by Third Point was once again Google. So we see Google showing up for a second time here. We had Chris Hone sell out of it 75% of his stake, but then we see Bill Ackman buy into it 10%. Then we see Daniel Loeb buy into it with an 8% position, which is a huge position with his portfolio because his is not as concentrated as other investors. So this is a significant buy by him. Now, overall, this is what his portfolio looks like. We have PCG, which is PG&E Corp, as 15%. This is his largest holding, and it's a value play. Then we have Colgate as the second largest, consumer defensive. Toothpaste is something people just routinely buy over and over again, the same brand. So this is a very defensive posture here. We have Donner Corp. We have Bath and Body Works. I'm not sure about the investing thesis on that one. Probably a value play. And then we have Google right there. He reduced his stake in Microsoft to add to Google, which I have no problem with that trade. I think that Google's trading at a better valuation right now than Microsoft. So overall, Daniel Loeb's portfolio is becoming more conservative over time. The most significant takeaway, in my opinion, is the Google buy. We see more super investors having bought into the company last 3 quarters. Now, moving on, we have Carl Icahn, what I would describe as vulture capitalist. He is ruthless in his investments. He's gone toe-to-toe with Bill Ackman before in a short squeeze. He does a lot of things that I'm less thrilled about the way that he runs his investment portfolio. But he is a big name and he moves markets himself. He only sold 2 companies here. He reduced his position dramatically in HRI, and he also reduced it in NWL, Newell Brands. We look at the buys that he's done. He bought in slightly to Southwest Gas Holdings, so a value play on a energy company, and he added a new holding, which is Illumina Incorporated. Now, I've never heard of Illumina before. This is a company I'm not familiar with, so I can plug it into Qualtrim and take a quick look at what this company does. It provides sequencing and array-based solutions for genetic and genomic analysis. All right, I know right off the bat I would never invest in this company. Even if I had an understanding of it, which I don't, but even if I did, these type of companies strike me as incredibly risky. Sequencing and DNA, the amount of R&D and risk associated with those companies, government intervention, it seems never ending. So this is not a buy that I'm personally interested in at all. Now, looking over at Carl Icahn's holdings, he has his primary investment vehicle, Icahn Enterprises, as 70% of the portfolio. In fact, the short seller, Hindenburg Research, released an extensive short thesis on Icahn Enterprises. And part of it was that it's so dilutive. It's a company that really dilutes all the shareholders to pay the dividend and to give stock-based compensation and payment to Carl Icahn. We can look at some of it here. Here's the shares outstanding of the company. You can see the amount of dilution that Icahn Enterprises is doing. It's completely crazy. But outside of that, Illumina is the only new holding to the Carl Icahn portfolio. Now, next up, we have Christopher Bloomstran, who is a value investor. He's a follower of Buffett methodology, and he runs a fund called Semper Augustus. And let's go ahead and take a look at it. Let's go see what his top sells were of the past 3 months. We have the very top one, the biggest one by far, which is All-In Corp. He reduced that by 17%. Then we have Valero Energy, ExxonMobil, and he slightly trimmed Costco and slightly sold a few more holdings that are very small positions. Now, if we go over the buys, we have the biggest one, which is Dollar General. He added 2% to the overall portfolio in Dollar General. And this is a buy that I like. I think Dollar General is a great company. It's more defensive than what people assume. It has better overall returns. In fact, I did an extensive video on Dollar General showing how it's had 20% total returns over a 10-year period, even though the company grows at 7% revenue. So Dollar General is a great growth story, a good company. Then we have Berkshire Hathaway. He added a little bit more to that one. The rest of them are slight additions to existing holdings outside of GE Healthcare Technologies. This is a new position that he added 0.12% to the portfolio. Now, Bloomstran's portfolio is pretty interesting because he has a high concentration into Berkshire Hathaway. He loves adding to this company on any dips. So anytime there's weakness with Berkshire Hathaway against the S&P 500, if there's relative weakness, he'll buy more into it. And right now, it makes up roughly 40% of the portfolio, almost 35%. It's a huge position combined. He's also big into All-In Corp. This is a company that I have no interest in. It's one of those chemical manufacturers. It's in that category that's out of my competency, out of my circle of competence. We have Newmont Corp as a 6% position. And then he also really likes Paramount. He believes that Paramount right now is like picking up a dollar for 50 cents. It's just a very undervalued company. I disagree on this one. I think that Paramount is facing a lot of struggles. I think it's going to be tough to sell the company as an acquisition play. Getting to scale profitability with streaming is very tough. And interestingly, on the subject of Paramount is a wonderful podcast that the Journal just came out with that showed how Paramount is being taken advantage of by the Yellowstone creator. The Yellowstone creator has such clout, such leverage over Paramount because it's really their only massive, huge success that's ongoing right now, that he's been able to really, for lack of a better term, kind of exploit the situation. He's really held Paramount hostage. He films a production of Yellowstone, and every single episode is costing around $20 million. To give an example of how much this creator is taking advantage of Paramount because he has them in a stranglehold, he's the only one creating content on their platform that's doing really well. Check out how much it cost to make the prequel to Yellowstone, the 1883 and 1923. The cost to Paramount was around $500 million per year to produce. $500 million to produce this show. And the articles really highlight how much he's able to exploit this situation. He rents cattle to Paramount at $25 a head, and he charges up to $50,000 per week for the show to film on ranches that he owns. So he has a filming crew show up. He charges them $50,000 just to film on his property. And he's also stated that it's the best business in the world, being able to have people film on your property. Sheridan also billed the studio $3,000 to pay a wrangler in Texas to fly 1,600 miles away from set, who was also looking to own the horses. So rather than just finding a wrangler in Montana, he's paying $3,000 to fly one from Texas. And this is a lot of the problems that Warren Buffett talks about as it being a bad industry. A lot of these insiders, these people that have these connections and they have leverage over the studios, they take full advantage of it. They bill everything to extravagant amounts. They charge to film at their own location, and they can do it because he owns Yellowstone. He is the creator of it, and Paramount they need it. They need Yellowstone more than anything. A lot of people have joked and called Paramount Plus Yellowstone Plus. That's how iconic that series is to that streaming service. So on the subject of Paramount, I just think the company faces so many issues, and I wonder why these super investors aren't more bullish on Netflix. The company has done really well. It's free cash flow positive. It's at scale. It's not beholden to any single content creator. It has a very streamlined, simple business. So that's something I'd love to ask Bloomstran about, is why he's so bullish on Paramount and not on Netflix. Overall, I like Bloomstran's portfolio. One thing he does is, even though you're never going to get the most outstanding returns investing with Christopher Bloomstran, you're not going to get wild 50x returns, but you're also never going to have the portfolio blow up. You'll never have a Tiger Global ARK Invest type of thing happen, where in a single year you lose 70% of your money. Now, next up we have Chase Coleman, who is on the other end of the spectrum than Christopher Bloomstran. Let's go ahead and take a look at how he's been trading. We have his sells over the past 3 months. He sold SentinelOne, Snowflake, Meta. He sold Match Group, Workday, HubSpot. All of these are less than 1% positions. SentinelOne is the only 1% position. The buys are similar. He has a lot of different buys, but his biggest buy, by far, is once again Google. We see what super investors have been attracted to over the past 3 months. So far, we have Christopher Hohn selling out of it, but then we have Bill Ackman buying into it, we have Daniel Loeb buying into it, and we have Chase Coleman with Tiger Global piling into Google. The super investors like this company, and this is a case where I agree with them. Overall, we have this as the biggest buy, 4.37% to the portfolio. After that, we have Take-Two, so we went into the gaming company there. And look at that, we have another buy with Intuit. Now, looking at the overall Chase Coleman portfolio, we have a high amount of concentration into a small amount of companies. We have Microsoft, number 1, 15.5. He already owns a lot of Meta, so he's done really well on that one over the past year as Meta's recovered. He sold out of that one to buy the rest of the big tech companies. JD's already a large position, but he added more to it, and then he also added to Amazon. But I also think that Tiger Global may have learned a lesson in 2021. They may have learned a bit of a lesson, because even though they're focused on a lot of smaller companies, they have far more recognizable, stable cash flow companies as their top 10 positions. I think it's a lot less risky than it was in 2021. Now, next up, we have an investor, a super investor that's a bit more than a super investor. We have Bill Gates, which, say what you will about him, and if you take away the personal opinion, you have to admit that Bill Gates, he was very good at running Microsoft. He did a pretty good job doing that. He's incredibly shrewd. He's crushed other businesses in the process. And he happens to be a very good investor. So a lot of those skills cross over. Now we're going to be looking at the Bill and Melinda Gates Foundation Trust. Let's go ahead and start off with the sells. We have only one slight sell, 4% of Berkshire Hathaway. So he reduced his stake in Berkshire, and then we have Weber, which he sold 0.06%. Very small one there. If we go to the buys, we rank it by change to the portfolio. We have Donner Corp and we have Hormel Foods Corporation. These are both very, very minor buys. And then we have Ecolab, which is another very minor buy. Overall, I would say that this is not much change. The only change here is he took a little bit of gains in Berkshire. When I look at the holdings of the Bill and Melinda Gates Foundational Trust, I see it as a very, very solid portfolio. He owns a ton of Microsoft. I think, again, I've said this before, Microsoft is the poster child of the perfect fundamentals in a company. He owns a lot of Canadian National Railway. Whether it's Canadian National Railway, whether it's Canadian Pacific, the Class 1 railroads are incredible with their moat, resilience, and their economics. So this is another very strong company, making up roughly half of his portfolio, just these two together. Then we have Berkshire, a 16% position. And then after that, we have Waste Management, another company that is critical infrastructure to the US. It's a company that's not going anywhere away. Waste Management is a great compounder. After that, we have Caterpillar, Deere, Ecolab, Coca-Cola, Walmart, FedEx, Waste Connection, Crown Castle, so on and so forth. This is a very solid blue chip portfolio focused on companies that have incredibly wide moats, and obviously a huge percentage into Microsoft, which he knows very well. So Bill Gates runs a no-nonsense portfolio. I think that one means business. I don't see it being disrupted or suffering any large losses. I think it's going to do just fine. I would be fine having my money in any of those companies. So that is it. That wraps up round 2, part 2 of the Super Investor Review. I hope you're enjoying these videos. I might do another round if we get another slate of great 13F filings from great investors. So if you haven't already, make sure you're subscribed with the bell notification. If you want to support the channel further, you can check out the Patreon membership. It gives you access to Qualtrim Insights, which is a tool I use for analysis, as well as the Discord community and a lot of exclusive content. So if I don't see you there, I'll see you in the next one.